With the Tax Cuts and Jobs Act of 2017, a new deduction for certain business owners was added called QBI, Qualified Business Income Deduction. But what is it and how will it help you as a business owner lower your taxable income? Well, in this episode, I'm going to break all of that down for you. Stay tuned. Welcome to Say Yes to Profits. Here at Say Yes to Profits, we help consultants build million-dollar firms while tripling their cash flow and profits without stress, struggle, or burnout. Now, our goal is to make you smile when you log into your bank account because you have more money, more profits, and you're paying less taxes. So subscribe, follow, and listen up. And as a result, we will make it rain money in your business. Now join me on the path to say yes to profits. Hello everyone, I am Octavia, CEO of Say Yes to Profits, the virtual CFO for consultants and service-based entrepreneurs who desire to have more money, more profits, and pay less taxes. Today we will discuss the Qualified Business Income Tax Deduction. Now, the QBI tax deduction is where certain businesses are allowed to deduct 20% of their qualified income. Businesses operating as a sole proprietorship, LLC, partnership, and S corporations are eligible for the Qualified Business Income Deduction. Businesses operating as a C corporation are not eligible. Also, there are other entities such as trusts that are eligible for QBI, but for the purpose of this video, it will only pertain to qualified businesses that I just mentioned. Now, the qualified income is the net amount of qualified income, gain, and deductions and losses from the qualified businesses that I just mentioned: LLCs, sole proprietorships, partnerships, and S corporation. For the QBI deduction to work for your business, you can only include taxable income. Income such as interest, other passive income, dividends, capital gains or losses, wages income, annuities, amount received as reasonable compensation for an S corporation, amounts received as guaranteed payments for partnerships, and payments received by a partner for services other than in the business itself are not included. Then you have qualified expenses. To determine your business's net income amount, you will take your revenue minus your expenses, and what is left over is your net income, or in some cases, a net loss. To determine the expenses used to calculate your qualified net income, they must be effectively connected with conducting business in the U.S. Also, the expenses must be ordinary and necessary to operating your business. To determine the qualified net income, for an example, let's say you have gross income of $300,000 and your total annual expenses equal $175,000. That means your qualified net income is $125,000 and your QBI tax deduction is 20% of that, which is equal to $25,000. You with me so far? Now let's look at the appropriate business tax forms. Now, of course, with this tax deduction, just like any other tax deduction, there are caveats and there are limitations. First, you must include your total taxable income, not just the qualified business net income. So I'm going to break this down for you. If you are a sole proprietor or an LLC, your business's profit and loss will be on a Schedule C. If you are an S corporation, your business's revenue and expenses will be on the 1120S. Then you as the owner will receive a K1, and the amount on the K1 will be based on your ownership percentage. If you are a partnership, the business's total income and expenses will be on Form 1065. You will also receive a K1 based on your ownership percentage. The information from those forms will be carried over, or they will appear on the 1040 form. Now for 2020, the total taxable income for you as a taxpayer is located on line 15 of the 2020 1040 form. Now, once you have this number, you have to determine eligibility based on the IRS thresholds and limitations. And there are two that I'm going to go over. Number one, your taxable income needs to equal to or be greater than your net income. And number two, your taxable income can't be higher than the IRS threshold amount. Now for 2020, the tax year, the threshold amounts are broken down based on filing status. For married, the threshold amount is $326,600. For single, it's $163,300. Now, if you exceed these threshold amounts, this deduction can begin to phase out. And also, it can get a little complicated. So just keep that in mind when you're determining your QBI. Now, if you have a business loss, your loss can then be carried over to the next year so that you can possibly qualify for the QBI deduction. So I want to give you some CEO next best steps. As the CEO, the QBI tax deduction will enable you to keep more money in your business. But this deduction can be extremely complicated. Therefore, I recommend you seek the help of an experienced accountant or virtual CFO, such as Say Yes to Profits, hello, to help you file your taxes and to determine if you qualify for this deduction. Also, drop me a comment or a question and let me know your thoughts on this video. And don't forget to subscribe so that you don't miss our next video. This is Octavia Conner, the virtual CFO for consultants. Until next time, say yes to profits. Toodles!